You're listening to The Intellectual Investor, episode number 123, Vitaly's Talk with Indiana University Students, Part 1. To learn more about Vitaly's investing firm, IMA, go to imausa.com. Vitaly's Talk with Indiana University Students, Part 1. In Part 1 of this two-part series, Vitaliy talks with Indiana University MBA and MSF students about his approach to investing. He covers a variety of important topics, such as how to find your own investing style, sell discipline, and the limits of screens for finding great compounders. Enjoy.
I just want to welcome our guest speaker, Vitaly Ketzen-Nelson. He's a CFA. He's the CEO and Chief Investment Officer at IMA, where he joined that firm in 1997. He's received both his Bachelor of Science and Master's of Science in Finance from University of Colorado at Denver. His two books, Active Value Investing and Little Book of Sideways Markets, were both published by John Wiley & Sons and have been translated into 8 languages. I think he actually has had a third book since this bio is written about the electric vehicle market. I've downloaded that, but have not yet read it. That's on my summer reading list, Vitaly. So I'll know a lot more after I read that this summer. But his articles have appeared in Barron's and Financial Times, Forbes, Business Insider, CNBC, Globe and Mail, Market Watch, among others. One of his two books here. He's also been a guest on CNBC, Fox Business, BNN, and Yahoo Finance. Kind of a funny little story. After I had reached out to Vitaliy to speak to us a few months ago, and he was kind enough to set aside time this afternoon to do it. And I was just reading an article, I don't know, on an investment website or what have you. And it was I've owned some of the pipelines in the past. So I was reading this article about pipelines, and I got about halfway through it, and I said, man, this is a pretty good article. This isn't the kind of stuff you usually just get from the financial press where they pull a couple quotes from one person who owns the stock and one person who shorted or whatever. And I looked down at the bottom and it was actually written by Vitaliy. I was like, oh, this is great. I'm glad I asked him to come speak to us because I thought it was a really good article. But he has close to 20 years of investment experience. He's taught graduate investment classes at the University of Colorado at Denver, and he also speaks to investor organizations in the U.S. and abroad. He's a CFA charter holder and has served on the board of the CFA Society of Colorado, and Forbes magazine have called him the new Benjamin Graham. So that's not too much to live up to there, Vitaly.
Very low expectations.
Yeah, right. Set the bar. So just so you understand the audience here, all the students on here are graduate students in one of 3 programs. They're either in we have MSF and MBA students. So we have MBA and resident students, and we also have MBA students who are online students through our Kelly Direct program. Indiana has one of the top online MBA programs. And then we also have students who are Masters of Science in Finance students as well. So 3 programs, and they all kind of can come together in this class where we get together, talk about equity markets, and they put together a big equity analysis that they present to a board of alumni at the end of the semester. But we like to try to get some practitioners to come in and speak to us, and authors, and the students usually love that. So with that, I'll turn it over for you for a minute if you want to make any opening remarks or set the stage, and then we'll start hammering you with questions as soon as you'd like. So let us know.
Actually, I'll just make a little note. My son, who is 19, he's going to see Boulder. He's transferring to see Boulder next year. He has his best friend at Indiana University, and he got both shots of his vaccine. So he was just there, literally, probably in your campus, maybe 10 days ago.
Okay.
Anyway, Okay, so I really don't have a lot of opening remarks, but I want to communicate one point to all of you guys. And there are a couple things. Number one, invest, don't gamble. And I think this point is kind of gets lost because right now, because a lot of because you buy a stock does not make you an investor. Okay, like in casinos, it's much easier, right? Because when you go to casino, it's a gambling domain, right? The chips, those are games, so that's gambling. Stock market, the kind of the line between gambling and investing is often ambiguous. I can be a gambler too if I buy a company that I know nothing about how much it's worth. I'm not really investing. I'm a gambler. Just because my title says CIO does not make me an investor. My process makes me an investor. So, and I think today it's very easy, just because you know the name of the company and even know its product, that does not make you an investor. What makes you an investor is going through the process, analyzing the company, figure out what it's worth, and then buying it. But everything, and the reason I'm telling you this because I see all this behavior of people on Robinhood, and I just realized they really did not democratize gambling. I mean, investing. What they really did, they democratized stock market to use a platform for gambling. So, and I think the way the app is created, etc. So that's point number one. Point number two, and this applies not just to me as a speaker, but to all the other speakers you're going to have in this class. The way I invest is appropriate for me. Like we run a 20, 25, 30 stock portfolio. Some investors run a 50 stock portfolio, some run 10 stock portfolio. The 20, 25 stock portfolio is appropriate for my EQ. It may be not appropriate for your EQ, your emotional quotient. So when you pick an investment strategy, what you want to do, you want to listen to what you want to get out of these lectures of guest speakers. You want to look for insights, but you not necessarily want to replicate the way I do things. You want to take what I tell you and then ignore 90% of it, most likely. But if there's something that clicks with you, you want to see, does it really apply to me? Does it really match with my personality? Does it really match with my investment process? And so if you like, I'll give you an example, because I do these things quite often. Somebody tells me, what do you think about gold stocks? And I say, I usually don't like mining companies because they're bad businesses. What you should get out of this is not that you should not do anything, you should not look at gold stocks. You should say, oh, why does he say they're bad businesses? You see what I mean? So don't just because I don't like these companies, first of all, I could be wrong. But second of all, I have developed over the years a lot of biases, as any investor does. But those are my biases. They shouldn't be your biases. Anyway, so these are my opening remarks. How's that?
That's great. So, folks, if you guys want to ask a question, I think maybe just run that through. You can just put the question up on chat, or just say you have a question. I'll call on you, and then of course you guys all put together questions and gave them. So I have those. So I'll be moving those along. So, Vitaliy, the first question already was submitted by Alexander Galt, one of our MBA students. And they wanted to know, kind of on that note, how did you go about developing your investment process, your philosophy, your sell discipline? How's that changed over time? What maybe are an example of, say, something recently that's changed in that? And then how do you adapt that to different industries, market caps, et cetera?
Okay, there's like 4 questions in
Yeah.
This is good. Okay. So how do I develop my process? So this is so investing is to some degree, it's like the way you develop is the way, everything about you, us, is path dependent, right? your experiences shape you as a person. The interaction with other people shape you as a person, and so do interaction with other investors. The stocks you buy, the stocks you lose money on, each one kind of contributes little by little, kind of molds you as an investor, as a human being. So when I joined IMA, we were kind of what's considered to be growth at reasonable price. We're just buying companies we thought we can grow for a long period of time, and most of the return we were looking for to get was just from growth. Not much would came the price earnings, expansion, and maybe some of the return would come from dividends. That's the strategy of the firm, and that strategy worked for IMA's founder, did not work for me. That's how I was taught to invest, but then over time, I was introduced to value investing concepts, which were not at the core of IMA philosophy, by the way, and I kind of introduced value framework, but still with appreciation for growth. So see how I molded by exposed to IMA environment, and then I was introduced to value investing, and I kind of molded them together. So that's what basically happens to us as human beings, right? It's a whole bunch of different factors, and then my self-discipline was just basically developed by reading a lot and thinking a lot about this. And there is a terrific book on selling called, it's by Don Cassidy, who's a friend of mine, and it's called "It's When You Sell That Counts." It is probably the best book on selling discipline, period, by far. How my selling strategy has evolved. So I realized I'm gonna own two types of companies. For one company, and I'm generalizing right now, it's gonna be a slower grower where most of the source of the return will come from not earnings growth and sales growth and dividends, but may come from price to earnings, expansion. Right? It was very cheap, and then it gets to fair value. So with these companies, my self-discipline has to be a lot more discreet. Like, when it gets to 90% of the fair value, I start selling, and maybe start selling chunks. When then you have companies that have a huge growth runway, they are operated by kind of owner operator, somebody who started the company, or a CEO who owns a lot of the stock, and they have a high growth runway, owner operator, and they have high return on capital. So this company, so think about, you have this, think about this company like Google, for instance. Okay, Google, your self-discipline should be a lot more like if you walk a dog and you have two leashes. There is a short leash for, you have a short leash for kind of a slow growing company, and then you have a long expanding leash for company. I'm just generalizing, a company like Google or somebody like that, because they have a huge growth right now. They have high return on capital, so they can take this money and reinvest in for a long time, because there is a huge growth runway ahead of them. And you have a management who is going to do the right job allocating this capital. So your investments, your self-discipline should be different between these two companies I described. Eric, did I answer all the parts of the question, or?
Yeah, I think the other thing, does your process and philosophy change by industry, or is that you don't really look at it industry, you're looking at it more like the discrete multiple expansion versus intrinsic value growth?
I think the only caveat would be if you're looking, it's a cyclical versus non-cyclical industry. Companies with, in a cyclical industry, those are more complicated. Those gets very tricky, because a lot of times when they're cheap, when they appear to be cheap, that's when they're expensive. Because what happens in a cyclical business, your earnings go from feast to famine kind of thing. It's just they go from nothing to a lot, and then to nothing again. And maybe even over in the long run they're growing, but it's just there is a huge volatility of earnings. So when these companies look cheap, in a sense, the E is very high, and and the P looks low. That is actually when they are at the end of their cycle, and this is when you should be selling. So I'm kind of aware of that. In the kind of if I own cyclical companies, we rarely own them. That's again doesn't mean you should not own them, but it just does not fit well with my personality, with my with my IQ as an investor.
All right. So Andrew Conrad, one of our MSFs, had a question about kind of margin of safety. So one of our speakers was Monish Kabrai, and I think he came from the kind of opposite end of the spectrum where he was deep value, and he's kind of moving more towards compounders. So he talked about when he was really doing the deep value investing, he would maybe look for something that's 40 cents on the dollar or something. So as you've added in kind of more and more of a value tilt into your process, how much of a margin of safety do you want to see in the investments that you make?
Let me tell you a story about Monish. So this is like 2007, 2008. And I'm speaking at the Value Investing Congress in California, and I meet Monish for the first time. And I talked to Monish, and I said, Monish, how can you run this very concentrated 10 stock portfolio? Because those are very large positions. He's like, don't look at me, look at this guy. And he runs a 3-stock portfolio. So you see how for him, the 3-stock guy with 3-stock portfolio, that was too concentrated, and 10 was appropriate for him. But for me, 10 was too concentrated. And so that this is going back to my point that you really have to choose what's the right thing for you. The 10-stock portfolio is right for Monish, not necessarily right for me. So when at my firm, the way we look, and I think this is a very important mental model. You can modify the hell out of it, but it's actually a very important mental model. When you look for how much margin of safety you require from a company, one of the most important factors should be its company's quality. The higher the quality of the company, the less margin of safety you require. Okay, think about it. If you're buying a company which has a very predictable, stable, when you buy a Walmart, hypothetically, it has incredibly stable and predictable business. There's a huge moat, great balance sheet, right? For Walmart, you don't need as much margin of safety because there are fewer things will go wrong. And then you look at another company in that space that have a lot more debt, may have a more fashion in their business, and then there you need a lot more margin of safety because there are a lot more things can go wrong. Because margin of safety, all it does, it protects you from the future being not as good as you think it would be. Okay, so the future of a high quality company, the deviation from the future of your expectations probably not going to be as great. Again, I'm generalizing, but I'm giving you a mental model here. Okay, where deviation for future is low quality company, the outcomes could be very, very wide. So that's how I would approach that.
So when you're looking at these compounders and so forth with high quality management, good growth, so forth, as the outcomes are maybe a little tighter, you wouldn't necessarily need the margin of safety as you would on, say, a cyclical company or lower quality.
Yeah, well, there was one point, one thing you want to stress is that a lot of times these companies, you just want to make sure the moat is there, right? That moat is there. We bought this company a while back, Twilio. It's a high tech growth company, etc. When we were buying, the stock was so cheap that I could, at the time, I could make an assumption. I didn't have to be very smart. In a sense, I could make very conservative assumptions. And with those assumptions, I would still not lose money. Okay. In other words, that was my margin of safety, right? If as the stock price increased, my IQ had to increase exponentially at a faster rate than the stock price, because now let's say you buy it at $25, you can be assuming 20% revenue growth. For a company in a fast-growing industry, that's actually was a conservative assumption. Not typically, but in that case was conservative assumption. Now the stock goes to $75, and so suddenly you're now at 20%. Actually, you're going to lose money. 20% revenue growth. So now you're like, well, can they actually grow at 35% and 40% and 50%? And there you have to be so much smarter. So the issue is, how do you have to, the way, and this is what Monish was talking about, you want to buy these companies and then just pray that you are understanding of the business, kind of stays in line with when the stock price goes up, because anyway. So that's I'm not really answering the question, but I guess I'm giving you another example of complexity of investing.
No, I think that works. You don't have a hard and fast rule of I'm buying something at 20% of what I'm doing.
No, we do. We do. We do a lot of qualitative work, but we also, for structuring portfolios, we have a quantitative frameworks that take our qualitative thinking and quantify. And so our margin of safety will be, we use a required rate of return to figure out margin of safety, but it ranges basically from 15 to, well, it's probably, to make it simple, we're probably looking to discount somewhere 50 to 70%, roughly. I'm just, without going into the inside baseball of how we do things, 50 to 70%, probably, most likely.
Okay. One of the MSF students, Justice Boyce, wanted to, when you look at companies that say are acquiring other companies, how do you look at growth that's organic versus inorganic? How do you factor in, say, synergies and acquisitions, or do you give a discount to inorganic growth rates? How do you look at those types of companies?
So when you own small companies, and I'm generalizing right now, it's a very general comment because there are a lot of exceptions to that. The way you lose money on those companies a lot of times is when management mismanages the business, makes bad decisions about inside the business. When you own larger companies, usually the way you lose money is by management making stupid capital allocation decisions. Because, and again, I'm generalizing this, and so there are a lot of exceptions to this, etc. And this is what you learn from these talks. I'm looking at these big statements. There are a whole bunch of exceptions to them. But we own this company where they were a British defense company, and 5 or 6 years ago, they bought a business. So their business was running, basically repairing and servicing submarines in UK. It's a very good, stable, probably not very growing much business. To create growth, they bought from another company a business they were flight airplanes to put out fires, to bring rescue workers to different parts of the country, in this global business. 7 years later, they took a 1.7 billion, which I think is the cost of the whole acquisition, right down. In other words, they spent $1.7 billion of shareholders' money and basically saying, we just threw this money away. Just think about this. This is a company, that's a half company's market cap. So I just gave you a kind of horror story. And by the way, there are a lot of those. But then there is a company, and we own a company, and by the way, if you want to study company that has created great value for shareholders through acquisitions, take a look at a company called SS&C, Sam Nancy Charles. Okay, it's run by Bill, and I'm going blank on the last name right now. He started the company from his basement in 1980s. And then little by little, he bought software companies. Okay. And he would buy a software company, he would improve it, take out costs, and it may look on the surface he would pay a high price, but after he takes out all the costs, etc., and integrates it, it's actually ends up being cheap. And he has done this for 30, probably close to 30 years. Bill Stone, the guy's name is Bill Stone, and he's done it for 30 years. So this is the company where acquisitions are in its culture. And they're it's but I say this, if they start buying companies that lease aircrafts or build submarines, I'm going to get very skeptical very fast. Okay, but when they buy adjacent businesses that they understand, they bought a company out of Kansas City, DST, and that company, it was a mutual fund servicing company, and they had a profit margins of 12%. He took those margins up to 40%. Just think about it, from 12 to 40. And they're still growing. So a lot of times you do this and you kill growth, and they're still growing. So my point is, when a company like that makes acquisitions, I celebrate. Oh, and the one little fact, Bill Stone owns 11% of the shares. So I know that from every dollar he spends, 11 of it is his, 11 cents is his. So if he makes a mistake, it's not going to be because of indifference. So, but so you see two contrasts, so when companies, also even when your companies in the same business make acquisitions. In fact, it's kind of, Eric, I'm going through the memory lane of all my, kind of my losses, and if I go back, all those companies at some point made an acquisition that just went bad. So, when you have two companies with two service businesses merge, those mergers are very difficult as well, because especially if synergies are part of the strategy, and if they equal size, especially if they equal size, because now you come to work. Just think mentally. You're working for one of those companies, and now this merger announced, and they talk about synergies, and you start thinking, am I the synergy, one of the synergies? And you start putting your resume in LinkedIn and looking for another job. And guess what? This is a service business. So now you're not thinking long-term, you're thinking about, because you're always going to think about yourself first. This is part of being human. And that's how these companies get in trouble. So when we analyze companies, this is something again, going back how my investment process, was developed by, through a lot of painful experiences.
So where do you come down? So again, like Monish was talking about certain sectors he just doesn't want any part of. Do you diversify across the economy? Or are there certain areas that you kind of eliminate on the front end? How do you view that?
So there's certain bits. Let me do this. Because I don't want to spend that much time on going into a rabbit hole. But I'm gonna, guys, if you go to sixcommandments.com, 6 Commandments, download this chapter I have from a book that I may publish someday. It talks about value investing, and there I talk about this concept of IQ and EQ, emotional, because and so because I think this is probably one of the most important things you read, from me at least, about investing, about the EQ and IQ. But anyway, so whenever you buy a company, that company has to be a good fit for my personality. Okay, so I usually stay away from highly leveraged companies, because I know that my EQ is going to be very low with those companies. When something bad happens, I won't be rational. I won't be going back to my models and rationally look at different scenarios. I'll be freaking out. So this is why we are designing the portfolio where I'm maximizing the little intelligence that I have to work as effectively as possible in in our portfolios. So so usually avoid for company. We usually have very low exposure to companies that are exposed to commodities. But see, this is remember how I started this conversation, that because we do that doesn't mean you should be doing this. In fact, if one of you have has a lot of insights about oil industry or commodity industries, etc., that actually should, that could be actually your strength, right? And therefore, you should be looking at this and saying, okay, well, that's not for Vitaliy, but that's okay, that's for me. But so for my EQ, I mean, you usually stay away from very cyclical businesses, with a lot of debt. And I want high quality businesses. That means usually high return on capital, all these things, all the good management, etc.
So Vitaliy, Chris Morton, one of our Kelly Direct students, saw in some footnotes that you had in your active value investing that you talked a little bit about some technical indicators, which isn't typically thought of with a value investor. Do you ever use those in your, buy or sell types of decisions, or is that just kind of on the margin as you're getting in or out of a position?
I don't know if you read my book, because I don't think I ever. The only time I talk about technical indicators that I only use them. So I think that's
okay. Well, maybe that was just a mistake there then. So what about so you have kind of a lot of the Buffett value school of thought that's very qualitative and holistic, and then you have kind of a lot of quantitative value investors. If you're on the kind of Buffett side, is there a way to use some of the quantitative stuff to inform you, or do you have to keep those things separate? What are your thoughts on kind of holistic qualitative versus the more quantitative side?
Warren Buffett is 90-something years old. I think he's not. I forget. He's 90, right?
I think that's right. Yeah.
I think he's 90 years old. He spent most of his life was when computers were non-existent, or at least they were not really accessible to widely accessible. And therefore, he was formed as a person who can do complex math in his head, who can, who basically developed his skill set without computers, for the most part. For a long time, I was saying, I don't need to use Excel because Warren Buffett doesn't use Excel. That was the dumbest thing I ever did. Because, first of all, let's be honest. There's Warren Buffett's IQ, and there's my IQ, much lower. Just so let's start with that. So Warren Buffett does not use Excel. I need any help I can get. Okay, so why handicap myself, right? If I was Warren Buffett, if I had IQ of Warren Buffett, maybe I wouldn't need to use Excel. That's that's point number one. Point number two, all you're trying to do in investing is you have a puzzle. A puzzle is just basically there is a lot of information out there, and all you're trying to do is put this information together and try to understand, okay, what is this company worth? Okay, if running quantitative indicators will tell you, oh, there is the inklings that this company is a high quality company. I'll give you just an example. Like, let's say you look at return on capital for the last 15 years, and it's been very high and stable for a long period of time. Oh, there are inklings that this company has a very good moat. Does it mean that it has a good moat? You don't know yet, right? But it's actually, now you have a thesis. So just taking a whole bunch of information using quantitative analysis, not technical analysis, but quantitative analysis, and to give you some data point, convert this complex, a lot of noise into useful information. there is absolutely nothing wrong with that. We use a lot of spreadsheets at IMA, and we have models that we do in a certain way because I find that we do much better work that way because we're not Warren Buffett's, So Eric, was that good answer?
No, that I think that answered the question. Vitaliy, so Jonathan Cole wanted to know, how long do you spend analyzing an investment before you decide to buy it, and what are the kind of main factors there that are helping you make your decision?
All right. I'm so glad you asked me this question because I want to run this new analogy by you guys. The brand new analogy. Any of you read sci-fi? Science fiction? Yeah. All right. Well, when you read science fiction, you're basically, or fantasy or something like, something that is, you basically, the author wants you to go in the world that's not this earth. That's not the world that you're familiar with, right? So, and there are science fictions that take place in the world that you know, and then they take place in the world that has completely different rules. Like, it could be different universe, etc. Humans look different or whatever. Okay, so if you are reading the book where the author is basically, the story is happening in an environment that you know very well, that you are in it every single day, then it's going to be very easy for you to get to understand from the very beginning the whole story. If you reading something from Ian Banks, where he's building this brand new world for you, and there is all these different characters, all this, the rules are very different. Everything is different. It probably takes you 1/3 of the book just to understand what's kind of the world. Okay, and then you start to understand what's happening in the book. So if I'm looking at the company that is a kind of Ian Banks book that's which I know very little about, it's going to take me a lot more time to do research. However, here's the thing: once you read Ian Banks' book number 1, reading number 2 becomes easier because the world has already been built in the first book. So if I'm looking at company A, and then 6 months later I'm looking at its competitor company B, probably would have looked at it anyway when I looked at company A. But it's going to take me a lot less time because the world has already been built for me. Not for me. Already has built that world. So the amount of time it takes me to analyze the company is going to depend on how familiar that world is to me. How's that for the sci-fi? I brought some sci-fi finally into my speech.
So do you find yourself trying to stay kind of within that circle of competence type of stock, or are you constantly trying to grow that? How does that work?
So this is a fine. There's a fine balance by you trying to stay in your circle of competence, but you also try to always to increase, to grow it at the same time. And what makes this balance very difficult is that when do you step out too far that that you're too far from your circle of competence? But the thing is, if you stay in a circle of competence, you will never learn. That's basically it. So you always have to be able to grow it. Okay. I know my limitations. For instance, I was never a good student in high school, so my understanding of biology is very limited. So if I were today to analyze some kind of very, very niche biopharmaceutical company with one drug, where I have to use a lot of fancy language to understand the business, I know that I'm just not smart enough for that, or at least I don't have a tool, so I probably know, I know that not to go after this company. At the same time, I always try to find new industries to look at and to learn. And sometimes if I can build the world, I can study, build the world, Then I kind of created my circle of competence. And what I would do in the beginning, I would take smaller positions, because when you are in the new world, you still don't know what you don't know. When I'm in my circle of competence, like something I've been before, I think I already know most of the unknowns. When this is a new, when I'm going into new area for me, I try to learn as much as possible, build this world, but there are still things that I might discover that I did not know. I did not know. So our position sizing may be smaller in the beginning. So that's
right. So, so Daniel Roach asked, he had read your article on was our money manager kidnapped, and you talked about kind of this who, what, and how framework, and
yes.
For sports betting. And he said, you know, the what is often kind of easier than the who. So he wanted to know, what types of strategies do you use at your firm to try to help identify who those future dominant companies are going to be in a given market?
You know, it's very difficult. This light, that light, like one, you have to identify the what. Identifying the who is so much different, so much easier if there's a hindsight. It really is. It's almost like if you look at Google, right? Now it's so much easier to say, well, Google, we all knew it's going to succeed. Well, you have to remember that there was probably another 10 other search engine companies that have failed. So, however, there were periods of time when, speaking of Google, where you already knew that it's going to be successful. It's not in 99 or 2002, but maybe 2006 or 7 or 8, where you already knew that they will be successful, that they already destroyed competition. So I think you need to, like, I think when you use this framework, you have to have enough humility to say, I don't know. I don't know if this company is the who, is the one. But constantly be watching for this. And when one emerges, that's when you start, okay, well, how much? You start figuring out how much. And in that article, I was talking about Uber, like where I thought that was the who, for that space.
Right. So how do you actually go about kind of idea generation? Do you screen, or how do you come up with ideas that you then in turn look at and spend time on?
I do everything I can. Like I basically, we do everything. We run screens all the time. I read write-ups and news and letters by other value investors. I have a tremendous network. It's probably pushing over 100 people of value investors like me that share ideas all the time. I read a lot. Just anything you can think of that's rational, we do. I'm not asking for tips, from my cleaning lady kind of thing, but that's, but anything, anything that's rational, we do.
How do you how do you try to, I guess, obviously if you're screening for multiple expansion, you could look at lower multiples or things that have been lower than others. How do you try to identify some of the compounders?
I think the compounders probably not gonna, like, this is where it gets, screening has a lot of limitations. It really does, because it doesn't capture well future margin expansion. Screening is extremely backward looking, right? So screening has a lot of limitations. So probably not a good place to look for compounders. You can look for high return on capital, but even that number will be understated if the company, for instance, taking all the cash flows and reinvesting into R&D. So it's not going to show up on the screen. Maybe you can see companies that have this high revenue growth, they'll show up on screens, stuff. But screen has its limitations, and you're going to find certain type of companies. Like when we build a dividend portfolio, we were looking, we use a dividend screen. But what it just gave us universe of companies to look at. And then one by one, we went through this universe and analyzed those companies and kind of build a portfolio of 25, 30 stocks. But that's how screening has its own limitations. And this is what I really want you guys to get out of this. Investing is ambiguous. There is almost think about it, when a plumber comes to a house, he doesn't just come with one tool or a handyman. He has a toolbox. And a hammer is a great tool for one thing and it's a horrible tool for another thing. So there are you need to look at all these things that they all have limitations. Price to book, let me give you an example. Price to book is a useful measure when you're analyzing financial companies because book is marked to market every quarter. Price to book is worthless when you analyze technology companies. Because a lot of them don't even own factories anymore. Like Qualcomm is a technology company, they don't own factories. They design chips, somebody else builds them. So, so when I look at banks or insurance companies, even the insurance companies, there's some limitations to book. But when I look at banks, okay, book value actually is useful. When I look at software companies, I don't even know what the software, what the book value of Microsoft is because it's irrelevant. It's a completely random number. So when somebody asks me, what's your favorite measure? I'm like, well, you are a handyman. What's your favorite tool? That's my answer.
Depends on the job, right?
Exactly.
Thank you for listening. This and other investment articles by Vitaly Ketzen-Nelson are based on value investing principles that were first brought down from the mountain by Benjamin Graham and later were popularized by Warren Buffett. To learn more about these principles, visit investor.fm and listen to the first episode of this podcast, titled The 6 Commandments of Value Investing. To learn more about how Vitaly's investment firm uses these principles to create low-risk, long-term oriented portfolios, visit imausa.com. Enjoy life and prosper.